Doug knows that I really love the Q&A part and hate the speech part. But yeah, just to get started, it's been a surprisingly strong 2021. If you ask me, and if you had asked me at the beginning of the year to forecast the year, obviously we wouldn't have expected such a strong year. And I think, as I said there, it is the everything rally. And why was this the everything rally? Because the stimulus that the government in the US, and I don't think I'm going to be too different from the previous speakers, the government spending that has come through has effectively translated into a huge amount of disposable income to the US consumer. That US consumer now has a lot more money and is spending it. And it was a real Goldilocks world where you have this huge disposable income, yet interest rates haven't gone up. So the combination of those two things, plus the fact that COVID wasn't really a problem, led asset prices to be much higher. And I think that the key thing there is that people forget that asset prices going up tend to be self-fulfilling. There's an interesting thing that high asset prices give people confidence, which lead to high asset prices. But obviously on the other side, once asset prices go down, it's the same sort of thing. So I think we've got to be cautious just to build in the fact that asset prices continuously go up. And I think I'm going to talk about it a bit later, but the key is going to be this interplay between interest rates and inflation. Just talking about China, I think China was a disappointment this year. Why was it a disappointment? I think the key reason is twofold. The first is it was effectively a self-inflicted wound caused by the Chinese government. And I think they have a very long duration on how they think about the world. The GDP was fine, but they started to reshape the economy for what they think is important things that I guess the Western world is still to do, like the technology sector, the dominance of the technology sector, and also coupled with the fact that there's this tension between the US economy and the Chinese economy. We've seen huge flows. If you look at the actual US-listed Chinese stocks away from the US towards the Hong Kong market as the US investor sells China. So you've got these huge impacts that are influencing the Chinese economy. But on the other hand, like I said, on the US, you have this negative real rate, the stimulus. China's the opposite. It has positive real rates. The inflation rate's actually less than 2% versus the over 6% in the US. So there's a lot of fiscal room to spend for the Chinese economy and to stimulate if they need to. We don't think it's going to be this huge amount of stimulus, this back to property boom that the Chinese tend to go to. I think it will be a more targeted stimulus. So we're expecting China to come back, and absolutely as a long-term investor, they're doing things that will benefit the country over time. Just turning to the next point, which is the central bank and inflation. I think the word transitory was quite an interesting thing where the Fed throughout the year said that inflation was going to be this transitory thing. It was going to effectively, because of port congestion and other things like that, was going to normalize next year. Yes, that will be correct to a certain extent, but inflation is I guess, an outcome of the tightness of an economy. And that's why a lot of monetary authorities focus on two things, which is the labor market and inflation. And some people have dual mandates. And as the one tightens up, so they get worried about the inflation impact of a tighter world. And I think that's what's happening in the US. The word transitory started to get relegated at the end of the year by the Fed. The question is, once the port normalizations happen, will inflation normalize? We're not certain about that. And you can point to the housing market in the US, how tight it is, the low stock. The labor market is the key one that you need to look at for, I guess, perennial inflation above expectation. Because that doesn't go away unless you have some sort of large unemployment from these levels. So I think that's one of the things that we're watching to see if this is more persistent. And for now, it hasn't moved the bond market. As it says there, the bond market tends to be, we think, so there's this interesting thing that historically the bond market has been more correct than the equity market, and to a certain extent, the equity market is a lot more short-term focused, trying to understand what the next 12 months are. The bond market is looking way longer. So we are questioning the 10-year. There's obviously extraneous reasons why the bond market hasn't moved yet, but we think that through time, once things normalize, the bond market in the US especially has to go up to compensate. And yeah, I think that's important. On the South African economy, I would say that we've largely recovered. Yes, there were some blips. The riots obviously caused a big issue, but largely the base has recovered a fair amount in 2021. And the mining, I guess, Poncela, as it says there, the over 60 billion in mining taxes that we've received as a government should continue for another year, interestingly enough. So I think the balance sheet will be okay. But then the question is that sustainable? And our feeling is obviously once the prices of the precious metals normalize, we'll see a normalization of that royalty, and obviously the chickens will come home for the SA government. On the rand, also very interesting interplay. The currency is made up of, and I heard the question previously, the currency is made up of a whole different amount of participants, some wanting to buy fixed income, some wanting to buy the equity market, some wanting to do fixed investment, other people reclaiming their coupon, reclaiming their dividend. So there's a whole bunch of things happening. Last year, the SA economy or the rand had to absorb quite a bit of outflow on the equity side of things. Interestingly enough, a lot of it was from NASPA's process, redomiciling or listing, more shifting towards the process side. So there was a big flow out last year. So I think it is quite balanced in the short term. You've got what is not an appealing fixed interest or real yield in the shorter term in South Africa. The foreigners don't like to play in our long-term bonds because the liquidity is not there. The equity market has attractive opportunities given the valuation. So it's actually going to be quite a toss-up, interestingly enough, where the rand goes in the next year. The one other thing there, I just thought I'd just talk about one interesting concept. I like to start the year with an interesting thought. And why is there a book there in this opening slide? I think the reason there's a book there is because I'm reading a great book, and it mentioned that the average person reads around one book a week. If he reads one book a week for 60 years, that's around 3,000 books in a lifetime, versus 130 million books that are effectively in print. So the question now is, you've got a choice to do 3,000 books. And I think the key there is actually not what you read, but what you don't read. And I think that's the crux of it, is when you invest in the stable fund, you need to know what you're buying. And I think that question is answered in the way we try and manage the portfolio, is deliver a stable, resilient, inflation-beating return. And you can't do that if you're trying to hit for the home run every single time. And that's why we structure the portfolio with absolute mindset. We diversify. We have inversely correlated investments like the gold ETF. And therefore, yes, we might not be the top every single time, but there'll be this diversification benefit that comes through that produces the very solid returns. And we pay less attention to the relative performance, especially on a one-year basis. Just very quickly on the returns. In the last quarter, obviously foreign generated the biggest return. We had the rand, we had global. On a one-year basis, it was equities. JSE equities over 3%, foreign equities over 3%. Equities in total delivered more than 6% to our gross return of 9.7% for the year. I think the key there is there was relative underperformance in both of those. The resources obviously impacted the SA equities, and China obviously acted as a headwind to the foreign assets on a relative basis. And also being cautious on the place we were in the bond curve, which was the more mid-duration bonds, also didn't help on a relative basis. Just given our time constraints, I'll fly through this. Obviously, won't go through all of it. Looking ahead, I've mentioned the biggest risk for us is inflation. Inflation is potentially a persistent problem, more persistent than some people believe. It can get into the psyche of people, and as soon as that happens, it's a problem. In order for China, I think, as I said, there's a lot more they can do. We think that this could be a better year for China, but it's not going to be a super bounce-back year the way they stimulate in the previous times. But for a long-term investor, it's a really good time to be there. The question now comes that could you have another good GDP year around the globe, but a bad equity year? And we think that chance is rising. And it's quite an interesting dichotomy that economy does well, but markets don't do well. And markets are effectively only at these levels because interest rates are where they are. And we think about this could be the year of normalization where interest rates start moving up and the relative value of equities versus other instruments start to, I guess, impact the valuation on equities. But I think the important thing there is that if you own equities with pricing power, it's still a very good opportunity. I'm just going to fly through because I do want to take some questions. I think if you heard me speak the last quarter, this will be largely unchanged. A very big allocation to bonds, very little cash. We've got the gold ETF as a diversifier, and we're almost at maximum in equity at 38%. The question is which equities? It's important. It's those ones with pricing power. And we're small enough globally to find very interesting companies that we don't need to own the go-go type stocks. And the bond market, as I said, we're in the mid-duration bonds. I think these are largely going to reiterate what I said. Inflation is actually the worm that eats anyone's returns. People sometimes feel good when inflation comes through because disposable income's growing, things are good. But it's this interplay between you can't have everything great with inflation, demand, everyone feeling good and interest rates where they are. So I think this is potentially the year of normalization, and we need to kind of position accordingly. This was just the liquidity, exactly what I said. Liquidity driving markets, asset prices make you feel good, make everyone spend more. The go-go stocks, the kind of top stocks, Amazon, Facebook, etc., kind of largely in line with that liquidity. And the tail risk. I think people don't understand tail risk in this market. And I think the 10 years of bull market, even COVID, happened very quickly, bounced back. People struggle with this concept of tail risk. But we've got to be protecting in case things that we kind of have a low probability on actually eventuate. So I think I've said most of it. Aggregate asset classes will potentially be lower this year, given all the reasons that I spoke about. The bond market, you've got to be cautious where you are, especially globally. Mid-duration bonds, very good. Inflation beating. Capital, not really at risk, given the inflation outlook in the shorter term. And equities with pricing power are the place to be, with some gold as a diversifier. I think I ran a little bit over where I wanted to go, but I think you've largely got the idea. I'll now kind of join Doug for a little bit of Q&A.
Thanks, Nick. I'm not sure who that average book reader is who reads a book a week. Hopefully, there are more. That type of guys out there.
I think more or less.
I'm not sure. Maybe if it was YouTube videos on investment topics or interesting topics, I might get up to that level.
Well, my son and kids these days the average reader will be 0.
Yeah, exactly. Nick, some really interesting things that you brought our attention to there. There's actually a very interesting question here about whether China will be the next Japan. And I think if you break that down, it's quite an interesting question because, the evolution of China was the expectation that as they introduce more capitalism into their market, that you would see more of a democratic-led government come into play, and you would see more of a market forces coming in, and therefore that would release, I guess, the Asian tiger, so to speak, and you would see phenomenal growth going forward. And we've seen some of that growth, but more recently that has been curtailed, and we're seeing more restrictions through their regulations coming through, and that has had an impact on China. And some people are saying it is uninvestable. What are your views there, like longer term, from a more philosophical, political point of view?
Listen, I got 5 minutes, and you asked me a huge question, so I'll try and
Yeah.
distill it as best as I can. I think China, firstly, if it is to become Japan, is 15 to 20 years away from becoming Japan. Japan got to a point where their GDP per capita was almost the same as the US. So, from a GDP per capita basis, there's still a long way before you can even try and put them in the same bucket as the US. So they don't have to do half as well as the China of today to grow the economy immensely. So I think that's largely what happened was Japan got to a point where everyone was really wealthy, and then the demographic got them, and also the fact that the shareholder was always last in society. Whereas China, if you go look at it, they actually are okay with prosperity and people making money. It is a different concept for the West to kind of grasp this push and pull of you're allowed to make money, but then there's this overarching government that can, be a lot more in your face than in a Western world. But honestly, the framework that we think China are following is actually a very important one in that, and I've used the example many times, the things that they are doing, every single Western country sometimes wishes they would do. They're just going about it in a very draconian way. Should the after-school tutoring businesses have fleeced people? No. Should our kids be playing 8 hours a day of gaming? No. Should a lot of this happen? No. So they're reforming something, making hard decisions, which we think will benefit in the future. But it doesn't have to, because the GDP per capita is a quarter of the US, and it's just going to naturally grow as people are smarter and earn more and spend more in China. So I think it could happen, but it's 15 years away if it does happen.
Yeah, and another key topic that you brought up in your slide was around inflation.
Yeah.
I mentioned at the start, and Nick and I were actually having this discussion beforehand. I was just going through my intro and mentioned that, could this be a year of inflection? And what I meant by that was that, a lot of the rate hikes have been factored into, or a lot of the Fed's rate hikes have been factored into equity and asset price valuations. But I guess the risks is that inflation could print higher, and that could either lead to the Fed increasing rates at a quicker pace or to higher levels, or to surprise the market in some extent. And that could have an impact on equity market valuation. So do you see this as being, and I guess the point there is that asset prices inflect in that you could see them coming down, certainly some asset prices coming down.
I think it's a hell of an important question. And you, as I was just before you kind of came on, we were discussing it. I think I wouldn't use the word the year of inflection. I think it's too definite. I think people that forecast an inflection, it's very hard to get that turning point. I don't think the signals are there yet. I would more class it the year of normalization. The question is, what's going to happen is the interest rates are going to go up, and we're going to, we don't know to what level yet, because the Fed has signaled some dovishness, some hawkishness. But the fact is that we're going to have a year of normalization. I kind of agree that inflection is an interesting word, because I think we're nearing the point of something happening. And I would say that it's more a probability discussion around inflection than it is the year of inflection. I think there's an increased probability of inflection, but I don't think you need to position your portfolio with 0% equities. The sky's falling down, equities can't do anything. There are many things that can still do well. And we've had markets before, the tech bubble. The tech bubble burst, and the staples did very well. So within a market, there's still things that you can own that can do well. And I think we're small enough in the world that even if there is that inflection, there are enough equities that can do well in that environment.
And Nick kind of hits on another topic there where we were just discussing as well about I've been watching Bloomberg, I guess, in preparation for this, and you start to see this narrative starting to come through the media and how that could potentially impact your thinking about it. And you get so fixated on inflation or rate hikes that you forget the broader context. So, that discussion there is I guess, quite interesting in the context of a diversified portfolio. It's not just one scenario.
Totally. And I also said to stop watching Bloomberg and CNBC after that. And I think it is an important thing to shut out. There's so many people telling you, I'm going to tell you something, someone after me is going to tell you something. And I guess take the information and think for yourself. That's quite an interesting way of putting it. And I think sit in a room sometimes without turning on your TV and write on a piece of paper where the world's going in your mind. And speeches actually is a great way to think about the world, because I have to think about what I'm going to say to you, and it solidifies my thoughts. And I don't want to copy what some guy said on Bloomberg, because it's not going to help me. And I think that's sometimes what happens, interestingly enough.
So there you go. Not only have you walked away with some investment knowledge, you've walked away with going to read books, write speeches, and stop watching Bloomberg from Nick
And watch
Balkin.
Mr. Beast.
And watch Mr. Beast. We have to discuss what that means in a future presentation, because we've run out of time.